Current live market data indicates that MongoDB Inc., trading under the ticker symbol MDB, is experiencing a massive, parabolic move this morning, currently changing hands at exactly $408.86 per share. This represents an explosive intraday gain of approximately $79.99, or roughly 24.32% to the upside, just hours into the trading session on this Tuesday, December 2nd, 2025. The stock opened the session at $406.82, significantly gapping up from its previous close, and has already touched an intraday high of $419.50. The volume is pouring in heavy and fast, with over 4.6 million shares already traded, dwarfing the average daily volume and signaling that institutions are scrambling to re-rate this company in real time. This isn't just a green day, it is a complete repricing event that forces us to stop and examine exactly what is happening under the hood of this database giant. The expectation heading into this week for the broader software sector was one of caution. Investors had been skittish, worried that the high interest rate environment and the massive capital expenditure going into hardware names like NVIDIA stock were draining the budgets available for software applications. The prevailing narrative, the expectation, was that consumption-based models like MongoDB's were slowing down, that enterprise IT spend was being tightened, and that the AI boom was strictly a hardware story for now. The reality, however, has just smashed that narrative into pieces. MongoDB's earnings report, released late yesterday, didn't just beat estimates, it decimated them, delivering a reality that is far more bullish than even the most optimistic bulls dared to whisper. This tension between the fearful expectation of a slowdown and the stark reality of accelerating growth is exactly why the stock is vertical right now. You are watching a market that was positioned for mediocrity suddenly having to chase excellence. When we look closely at the catalyst, it is the fiscal 2026 third quarter results that have triggered this buying frenzy. The company reported adjusted earnings per share of $1.32, which is a staggering beat compared to the analyst consensus of 79 cents. That is not a margin of error. That is a fundamental disconnect between what Wall Street thought was happening and what is actually happening inside MongoDB's sales channels. Revenue came in at $628.3 million, beating the $593.4 million expectation. But the real story, the number that has hedge funds and individual investors utilizing their Schwab Intelligent portfolios and interactive brokers accounts to buy in, is the re-acceleration of MongoDB Atlas. Atlas is their cloud-hosted database service, the crown jewel of their business model. Growth for Atlas accelerated to 30% year over year. In a software market where many peers are seeing growth decelerate into the teens or single digits, seeing a company of this size re-accelerate to 30% is the golden ticket. It signals that the consumption slowdown we saw in 2024 might be over, and that enterprises are turning the taps back on. This brings us to the deeper analysis of why this is happening. The market has been treating software stocks as if they are second-class citizens compared to the semiconductor giants, but MongoDB is proving that it is the critical second phase of the AI trade. You cannot build intelligent applications, you cannot run agentic AI, and you cannot leverage large language models without a flexible, scalable data layer. The reality is that MongoDB is effectively positioning itself as that layer. While many were busy watching Apple stock or Tesla stock for consumer sentiment shifts, the enterprise architects were busy migrating workloads to MongoDB to prepare for the next generation of app development. The company's new CEO, CJ Desai, highlighted this shift, noting that while AI agents are still largely in pilot mode, the infrastructure build-out is happening now. This creates a fascinating disconnect. The revenue we are seeing today is just from the preparation phase. The actual consumption from live AI agents running at scale hasn't even fully hit the books yet. That is the curiosity loop that will keep investors engaged. If the stock is up 24% on the preparation for AI, what happens when the actual deployment phase kicks into high gear next year? Before we go further into the technicals and the future outlook, I want to pause and ask you a question about your own portfolio strategy. Comment below how many shares of MongoDB you currently hold, or if you were sitting on the sidelines waiting for a pullback that never came. It is always interesting to see how retail sentiment tracks with these massive gap-ups. Now, let's strip away the hype and talk about the business model, because understanding what MongoDB actually does is paramount to understanding if this rally is sustainable. In the old days, databases were rigid. They were built on rows and columns, like a giant Excel spreadsheet. This is what we call a relational database, and it was great for simple things like accounting or inventory. But modern data is messy. It comes in social media posts, sensor logs, video streams, and complex user profiles. Trying to jam that data into rows and columns is painful and slow for developers. MongoDB changed the game by using a document model. Instead of rows, it stores data in JSON-like documents. This means a developer can throw almost any kind of data structure at the database and it will accept it. It is flexible, it is fast, and most importantly, it speaks the same language as modern programming code. This is why developers love it. When you hear about investment help or online investing platforms recommending tech stocks, they often focus on developer love as a leading indicator. If the engineers choose the tool, the CIO will eventually sign the check. MongoDB has captured the hearts of the builders, and that is a moat that is incredibly difficult for competitors to cross. The company generates revenue primarily through subscriptions. Their main product, MongoDB Atlas, is a fully managed cloud database. You can go to any of the major cloud providers, AWS, Google Cloud, Azure, and spin up a MongoDB cluster in minutes. They handle the backups, the security, and the scaling. This database as a service model is extremely sticky. Once a company builds its core application on MongoDB, ripping it out is a nightmare. They're locked in, not by contract, but by utility. This creates a recurring revenue stream that is highly predictable, which is exactly what Wall Street craves. It's the same reason investors flock to Fidelity mutual funds or Fidelity ETFs that hold heavy weightings in SaaS, software as a service companies. The predictability of the cash flow commands a premium multiple. Additionally, they have MongoDB Enterprise Advanced, which allows huge regulated companies, think banks and government agencies, to run the database in their own private environments. This dual approach covers the startup building a mobile app and the massive bank managing trillions in assets. Let's look at the competitive landscape, because MongoDB does not exist in a vacuum. You often hear comparisons to Snowflake or Databricks. While they all deal with data, they solve different problems. Snowflake is a data warehouse. It's where you put data after it has been created to analyze it and make charts. MongoDB is an operational database. It is the engine that powers the app itself. When you log into your Robinhood app to check your Robinhood crypto or Robinhood fractional shares, the application needs to pull your profile, your balance, and your transaction history in milliseconds. That requires an operational database like MongoDB. Snowflake is what Robinhood would use later to analyze how many users traded crypto last month. However, the lines are blurring. MongoDB is adding analytics features and Snowflake is trying to be faster for apps. This convergence is the battlefield of the future. Right now, the market is telling us that MongoDB is winning the operational side of the war decisively. We also need to discuss the AI buzzword without sounding like a press release. The specific technology driving excitement here is vector search. In simple terms, for an AI to understand context, like knowing that bank means a financial institution and not the side of a river, it converts text into numbers, called vectors. Storing and searching these vectors is a new requirement for databases. MongoDB integrated this natively. This means developers don't need to go out and buy a separate niche vector database. They can just keep using the MongoDB they already know. This consolidation is a massive advantage. It prevents tool sprawl for companies. If you are using SoFi Invest or their SoFi Robo-Advisor, the underlying technology needs to be efficient. Tech stacks are getting complicated, and any vendor that can do 3 jobs, operational data, search, and vectors, instead of one, is going to win the budget battle. Let's shift gears to the trading environment and market mechanics. A 24% move in a company with a market cap of over $30 billion is rare. This suggests a short squeeze might be adding fuel to the fire. Short sellers, investors who bet the stock would go down, were likely crowded into this trade, betting on the consumption slowdown thesis. When the news hit that consumption was actually accelerating, those shorts were forced to buy back shares to cover their losses, creating a feedback loop of buying pressure. If you are managing your own money via self-investing or using an individual brokerage like Interactive Brokers, you have to be careful chasing moves like this. The volatility is extreme. We are seeing massive inflows, not just from active managers, but likely from passive flows. As the market cap rises, MongoDB's weight in various software ETFs increases, forcing funds to buy more. It's a mechanical bid that can keep prices elevated for days. The macro backdrop is also playing a role here. We are in an environment where interest